Hey guys, welcome to another episode of Bitcoin Intelligence. Today we're going to go through our third report, which you can find in your account. And this is mostly about tariffs. Today is Sunday, March 30th, and I'm recording this in the evening to get us ready for the Monday price action and the explosive week that we have. Obviously, the Liberation Day, April 2nd deadline is coming up. That's when a lot of the Trump tariffs will be revealed, and we will finally see how big they are. And some of the preliminary reports show that they're going to be substantially more than we have heard. So it can actually have a lot of negative effects on the markets, but if it's not nearly as big as feared, it can also lead to a sharp rebound in the market. So it's a very, very important week, and we want to be super prepared. Today, we will also be writing another issue of the report, but for now, I want to review what we published a couple days ago in our third issue. So first off, how can you access that? If you have signed up for our platform, you should be able to see this view. You just need to open a free account to access this. And in the Bitcoin Intelligence tab, you'd be able to see our charts and reports and some of the video analysis that we've uploaded. The address would be, if you just want to sign up, the address would be 21stcapital.com/BI. And then we have a lot of public data, including charts and other things, but the BI report will have to be, it is behind your account. So you have to log in first and be able to see it. All right, so first take a look at our main Bitcoin valuation models. The first thing we see is that Bitcoin VPLI has dropped together with Bitcoin's really, really weak price action to 45, and anything below 50 shows a undervaluation, essentially, meaning the bubble has fully deflated and we're actually lower than where the historical trend would have suggested, fully matching what we expect from the weak macroeconomic environment that we're in. And you can also look at a power law graph, which essentially shows that we should have been at 92,000 if we followed the long-term power law trend that Bitcoin has followed since day one. So we are a little bit undervalued compared to the trend. And if you look at the quantile model, which gives us the range of possible values, and maybe I can use this version, which is Plan C's beautiful visualization, you'd be able to see that we are around the 50th quantile right now, which is historically very favorable place, actually 48th quantile. And this can go, there's a lot of room to the upside, some room to the downside as well, but the risk reward is fantastic in the long run. So essentially, there is no bubble. The bubble has not even started. And if you look at the previous cycles, so you can zoom in a little bit, you see that bubble actually starts when we get into this pink and red region. So none of that is actually happened. So essentially, we are in the warm-up zone and or the transition zone, if you want to call it. And we are just waiting for macro and liquidity to come back. A lot of weak macro developments. So we have to wait for that to go away so that Bitcoin can resume the uptrend. So from a long-term perspective, we are in a really, really good spot for people who do dollar cost averaging or have a long-term view of investing. This is a fantastic place. However, short-term, we have a lot of uncertainty that we have been trying to cover and discuss in the Bitcoin Intelligence report. All right, now let's move on to let's move on to the actual report. And here again, at the end of the menus, at the end of the list, you can find the BI reports. This is what we published a couple days ago, on the 20th, 2 days ago. And here I basically covered some basic economic analysis of how tariffs hurt the economy and why the financial markets are really, really averse and they don't like it. I want to acknowledge that the latest research also shows that if you do them really, really masterfully, and if you have a lot of power in the market, which the United States has, you can extract a lot of good out of tariffs as well. But it's important to realize that there's a lot of cost. But if you have, a very, very smart approach, you would be able to extract some value here as well. And how do we understand the cost of these tariffs? And basically, we're going to go through a very simple supply-demand analysis to see why these tariffs actually hurt us and under what condition actually they might be helpful. But let's begin with what we write in the report. We wrote this on 28th when the market actually had crashed back down by a significant 2%. S&P 500 has been dropping quite a bit during the last few weeks, and a massive 2% on that day. So a lot of that is actually due to what we hear from Trump administration. And maybe we can bring me back on the corner. And I want to mention that we actually have been talking about the negative effect of tariffs pretty much right after Trump brought them up. At that time, a lot of people were still, comparing it to 2018 and saying there shouldn't be any effect. However, I was following the economic logic, which says there would be some downside when tariffs are enacted. And I'll explain why, but I maintain that view. And the last time I mentioned it was right before we actually do crash. And the market for a while after Trump came into office, for a while, the market was pricing in the tax cuts and a lot of the deregulation and business-friendly policies, and they were kind of sleeping on the tariffs. But we have been mentioning that tariffs will crash the market. And here only I have one last example of it, which we mentioned on February 1st. And we highlighted that right when we were close to the top of the market, we said that tariffs will crash the market and it will produce a fantastic buy spot. And so I waited for this crash to happen. And right at the bottom, if you follow my tweets, I realized that here short-term holders have been selling at a massive amount of loss. So I put out a tweet. Maybe later I'll talk about that, but don't really want to focus on that now. And I mentioned that this is where we will see a rebound, and I got put on some longs and unwound some of my shorts. But I also maintained the view that the macro actually still stays very uncertain. So I wasn't super happy or positive about the rebound. I wasn't jumping on the bandwagon that we are out of the woods, but we have to keep watching what happens, and we have to understand the fundamentals of what's happening around us. So that's why we are going to look at some theoretical discussion on tariffs, which is not useless as you might think of theoretical discussions. Actually, if you understand what's happening, it ends up being super, super practical. All right. So what happens with tariffs? Basically, tariffs are taxes on the imports. So your importers, your own economic actors, will be paying those tariffs. Now, here in the report, we actually go through the analysis step by step. Imagine initially we have no tariffs, and the domestic producers and domestic consumers are working together to find the right price, and the market reaches equilibrium. And on this graph, you can see we have price on this axis, we have quantity of supply and quantity of demand on this axis. And then this graph is a domestic supply and this is domestic demand. And when they meet, we get the equilibrium and everybody's happy and the market clears out. But when we add the external competitors, and for example, we have an international player that's for some reason is much better capable of producing the same goods, maybe cheaper or maybe higher quality. And once they come into the market, they drop down the prices. And what happens is the equilibrium is pushed down. And so you have this lower price, which is PW, price of the world producers, apply. And then the consumer will now have two quantities. One is the quantity they buy from the domestic producers. Essentially, you buy less from the domestic producers because now there is a competitor with a lower price. So the original quantity that you would have purchased from domestic producers, which was here, that quantity goes down to Q1. But the consumer is now much better off because now they have one domestic producer, which is good. And then they also have the international producer, which is cheap. So they have a lot more options now. So they increase the demand actually. So the quantity Q that they have been consuming now moves up to Q2. So they are consuming a lot more. However, they're buying a little bit less from the domestic producers and they're importing the rest from the foreign producers. So we get a Q1 here, and then the gap between Q1 and Q2 is the import. Essentially, to sum it up, once a cheaper producer comes into the market, you buy more from them, you buy less from the domestic producers, but overall you also buy more. So the consumer ends up being better off while the domestic producer is worse off. And in economic jargon, we call this surplus. The consumer surplus increases, the producer surplus goes down. Really, you can read the full report for a detailed treatment of this. But the general idea of tariffs is that, okay, so if these international producers are pushing the price down, maybe we could apply some tariffs to bring those prices up and reduce the damage on the domestic producers. And they actually do the same thing. So look at this graph. Once this price of the world is moved up because we added a tariff on them, while the consumer rolls back their consumption, they will be buying more from the domestic producers. So that orange surplus of the producers increases in size. And then they also buy less from the foreign producer, obviously, because it's more expensive. So a lot of things change, and there is this tax revenue that's created because on the imported amount, the government is charging some tariff. So there's tax revenue generated. This thing goes to the government. However, you can also see those yellow triangles that are essentially, they vanish. And this is the part of the economic activity that gets destroyed. Essentially, the customer loses options. So they buy more from the domestic, they buy a lot less from the foreign, but overall they consume less. So the economy shrinks a little bit, right? So that's what we call deadweight loss, meaning some of the economic activity shrunk. Now, so that's why a lot of economists in general are against tariffs. But again, like I said, recent research also shows that if you have a monopoly and you have a lot of power, which incidentally applies to the case of the US tariffs, you might be able to force everyone else to bear some of this cost. So if the foreign producers actually now end up dropping their prices, they will be absorbing a lot more of this economic damage themselves. So the country, the domestic importer, and the United States in this example might end up improving terms of trade with everyone else as a result, and nullify these negative effects and then some. So it is possible, but there's also this tax revenue that goes to the government, and that has some risk here because in the analysis we've treated that as equal to private consumption, but tax revenue is basically money that moves from private economy to government, and then you have to ask yourself whether government is going to spend that wisely or not. So there's a lot of uncertainty there as well, how efficient that spending is going to be. Everything equal, I would say government is less efficient than the private economy. So there are a lot of costs, but I do want to acknowledge that there are strategic reasons and certain cases where some controlled tariffs on certain goods might be helpful, but has to be temporary, has to be very well calculated. And you have to also take into account the risk of retaliation and so on. So that's why, in general, the market look at tariffs very negatively. Right? Even if you put all the theory aside, the market, the way the market thinks and understand it is that these tariffs are going to be growth negative and inflation positive. Because of that, we're going to have a lot of trouble with the Fed and liquidity if tariffs end up being larger and longer. So we have to be watching this a lot. All right. So let's move on. Okay, so who will be the losers and winners? Well, wherever you apply the tariffs, the domestic producers are going to be winners. Consumers are going to be the losers. That's why when you look at some of the economic data, consumers are losing their optimism about the economy. And like I said, the idea that government gets a stronger hand and stronger participation in the economy, that also, in my view, is not a positive factor. The more government interference, the less efficiency in general. So we really hope this stage two to be done, and we actually end up seeing the deregulation part of the policy set proposed by the Trump administration. We also look at inflation and growth data for obvious reasons, despite a lot of people not agreeing. We've been saying that tariffs will be inflation positive and they will cause prices to go up. However, this is temporary, right? Over time, we actually would see inflation come down, and later I'll explain why. But initially, they have to be inflation positive. Again, against a lot of people analysis, we are seeing some uptick in inflation. You see exactly from November, PCE in the blue line has been on the rise, and the drop in the core PCE has stopped. The latest number was also an uptick above more than the expectations. So inflation has been difficult to tame, and this is just the PCE. If you look at the CPI, it has also been rapidly rising in the last couple of months. Okay. And that's all just front-running an early effect of tariffs. And we might see more of that after the Liberation Day. When you look at the consumer, they're also very, very positive. They're very, very negative on the economy. And their inflation expectations have risen so much, officially more than 4% now, which is very rare, I think, comparable to 2022, but have not been seen in the last decade. Consumer expecting the long run inflation 5 to 10 years out to be more than 4%. This, a lot of people actually disagree that inflation expectations matter. I tend to agree with that. However, it matters to the Fed. So if this number goes up, the Fed will be less likely to cut rates. That's why it's really, really bad. And so to summarize this report, we looked at tariffs, why they are so negative for the market and why they cause the markets to crash. And we also looked at some of the effects on inflation and consumer sentiment. When will the markets recover? So whenever we do this kind of analysis, a lot of people are asking, okay, now tell me when are we going to be done? Now, the first thing that we need to happen is the tariffs to be rolled back and trade to be normalized. So it is possible that after these tariffs are implemented, foreign countries come to the table and make a deal that reduces tariffs for everyone. That would be fantastic for the global economy and the US, and very, very helpful for the financial markets. But on the other hand, if tariffs actually become larger and stay for a longer period, we will still have that negative backdrop in all of our analysis. And together with that, consumer sentiment should come back if tariffs are rolled back. And then we would begin to see, we begin to deal with the economic slowdown, because there are also other parts of Trump's policies that might be growth negative, including those spending cuts. There has been a little bit of a growth scare, especially if tariffs stay. We do have recession risks, because once that inflationary shock is absorbed and works through the economy, that actually ends up causing deflationary pressures, because when you can't access good supply from foreign suppliers, you'd have to produce less, and less production mean fewer goods for everyone and fewer economic activity, less jobs. So then you should begin seeing a less optimism in business, less production, less GDP growth, and less hiring. But I don't think we'll get to near a recession, but we will get a lot of fear of recession. So that might again be negative for the markets. We need that to also go away and pass for us to become bullish from a macro perspective. And the good thing is, if we do see recession fears, we do have the Fed put that will activate and come to the rescue of the market. So overall, what we need to happen is essentially tariffs should either not increase or decrease through exceptions or through some sort of deal. If that happens, a lot of the bad news is already priced in. So if tariffs actually stop looking worse, then markets begin to slowly recover. However, as I said, we still have two trends to watch. First of all, the inflationary effect of all these tariffs should show up as a shock, as a temporary rise in inflation numbers, and that might scare the Fed from cutting the rates. But that will go away in one quarter. And then if recession fears stay at the level of a fear, then everything will be ready for the Fed to come in and cut the rates, and the markets will recover. But if this is an actual recession, then of course that would be a different game. But we don't see anything in the data that would suggest a high probability of recession. Especially if you look at the game theory, Trump's objective is not to cause a recession. He simply wants to improve the terms of trade, build a legacy, benefit from all the publicity and all that, and then do everything he can to support the economy, right? So he will then pursue, after this tariff phase is done, he will pursue tax cuts, deregulation, any sort of levering the banking system to help the private economy. And all that is very, very growth positive. So throughout our analysis, our view has been that we will get a V-shaped economy moving forward. And since the beginning of Trump administration, that V, the first leg of that V has been happening. We are seeing the negative effect of tariffs. A lot of it actually, in my opinion, is already done. Then in a couple months, maybe in a quarter, we will figure out, essentially inflation data will stabilize, tariff and trade war will stabilize, and we'll also get some more data about recession, which if it's not as scary, then everything will be ready for the markets to resume the upward trend. All right, so that does it for our third report of Bitcoin intelligence. Thanks a lot for listening. And today, if we can, by the end of the day, we will publish issue 4. Worst case, it will be in your inbox by Monday morning. To get you ready for the upcoming week, we have looked at a new set of on-chain indicators and macro data to closely monitor what's going on. Again, as I said in the beginning, this is a very, very important time in markets because the market is ready for sharp moves, and we have to be following what's happening with the policy and the changes that the administration is doing to the economy to fully and properly navigate what's going on. So a lot of firework is going to happen next week after the Liberation Day, and we'll be watching very closely. Tune in for our reports, and if you like this video, like, share, subscribe, all the good things. If you like our report, also try to engage with it and share your comments with us. We'd love to hear from you and see what you think and whether you're benefiting from the reports and what other analyses you might want us to include. With that, thanks a lot for watching, and I'll see you in the next video.